everybody, in this video today we're going to be talking about the order of liquidity. Now what the order of liquidity is referring to here is how quickly something can be converted into cash, and we want to do so in a way that will not diminish the value of that cash. And the way that this is relevant to the preparation of financial reports is it's the order that we will list assets in the statement of financial position, which is sometimes called the income statement. So like I said, it's all about how quickly I can convert these items into cash. Now, the easiest thing to convert into cash is going to be something that is already cash. So your petty cash, for example. Now, petty cash is cash that you put aside to make small purchases. And you'd have someone responsible for this petty cash amount. And you would put it aside, and if you say you are a coffee shop and you run out of milk and you need to go around at the last minute and get some more milk for your coffee shop, then you would go to the petty cash fund, because you don't want people going straight into the till and taking the money out. That'll make it harder to reconcile the amounts at the end of the day. We want to be able to account for all that money. So you set up a special account that is separate, that is called the petty cash fund. And then your staff can go to that fund to get money to make small purchases if they need to make them. Ideally though, you'd be trying to make purchases as much as possible with bank transfers so that provides that proof of purchase. But that's not always possible. So where you need to make those small little incidental costs, you'd use petty cash for that. The other thing that is extremely liquid is cash on hand. So perhaps at the end of the day, ideally you want to be banking your money intact every single day, which means that at the very end of trading, you would go and take that money to the bank. But for whatever reason, if you haven't been able to get to the bank, or you've got some cash sitting around, hopefully you've got it in a safe, not just sitting around, but that would be cash on hand, and that's extremely liquid too, because it's already cash. The next liquid asset is going to be your cash at bank. Cash that you have sitting in your bank account. That's already cash too, so that's very liquid. You'd list that third. Now, the order that you list the next two in is sometimes switched around depending on who you talk to or which textbook you're reading. I like to put accounts receivable next. Now, accounts receivable are people that they're credit customers. They're people we've sold goods to on credit and they haven't paid us for it yet, or we've provided them with a service and they haven't paid us for that yet. We've given them the product or the service and they still owe us the money for it. It's like having an IOU in your wallet from a friend. And it's an item of value because they owe you money and it represents future money that's going to come into you. And that's pretty liquid too. Because that's pretty easy to convert that into cash. You just have to contact them and give them a nudge and say, hey, you owe me money. Give me the money from this amount, and that increases your cash balance. Now, for a trading business, the next one you would have up here would be your inventories. These are the items that you have purchased with the intention of reselling them at a higher price in order to make profit. So we would have inventories next. A service business, however, now most service businesses, it's not black and white. A lot of service businesses will provide a service but also sell goods. If you're a hairdresser, for example, you might sell a shampoo and conditioner, so you would have inventories as well. But a trading business would also, a service business would also have something we call supplies. Now, supplies are the items that we would use in the service. So that would be if I'm a hairdresser and I'm using hair dye to dye someone's hair. That would be considered a supply, and I would list that next. Now, the next thing that you would list after this is our main current assets we would have. The other things you would want to be listing in here are other things that are really easy to convert into cash, and the next category of things would typically be any kind of investments that you have, you would list next. So say, for example, I have some shares. I could sell those shares. That's pretty easy. That's a pretty easy way to make cash, but it's not listed further in the list because if the shares are not at a good value right now, I might lose some value in selling them, and that's why I don't put them up here. So remember that the order of liquidity is how easily it can be converted into cash without losing its market value. Without losing its value. And the shares might not be worth very much when I need money, so that's why it's not further up. But if I need money desperately, I can sell my shares and get money from that pretty easily. And if I lend money out to somebody else, apart from accounts receivable where I give them goods, if I lend someone money, that would be listed next. Then I'd like to just say to you, go down now from smallest to largest. In reality, a business would have what we call a chart of accounts, which lists all of the accounts of a business and the order you would list them in your financial records. But I'm not going to give you that in the exam, because then it'd tell you the type of account for each of them, and it would get rid of the whole reason that we're assessing you in that area. So I say just go smallest to largest here now. And so you might have things like your furniture, your motor vehicles, and then you're going to have those really illiquid assets like your land and your buildings. So here, let's just say you have a motor vehicle, and then perhaps you have your buildings and your land further down. The very last thing that you're going to have on your list is your goodwill, because it's very hard to convert that into cash. So you see down the bottom, the illiquid assets, the ones that are really hard to convert into cash, and they take a lot of time. So goodwill is your reputation, it's your existing customers, and it has a value. If you were to sell your business, that is worth something. If you sell a business that's been operating for a while, you've got a reputation, you've built that reputation up, you've got existing customers, and if you were to sell, that's actually worth something to you. And for that reason, that is listed last, because you would only actually get cash from that when you sell your business at the end of the day. So goodwill is always listed last. So to summarize, the order of liquidity is the order that you would list accounts in the statement of financial position, or the balance sheet, and you would list them in the easiest to convert to cash, like petty cash, it's already cash, to the hardest thing to convert to cash, which is goodwill, which you can only actually get cash from when you sell your business, if you were to sell your business at the end of the day. And you would list them in that order. Hopefully that made sense to you, and now you know the order to list your accounts in when you go to do a statement of financial position or balance sheet. Thanks for watching, and I'll see you next time. Bye.